The alarm didn't ring in a courtroom, it rang behind a luxury counter, when a routine return quietly broke a rule no one was supposed to notice. For decades, elite fashion houses have operated on trust, discretion, and silence. Returns are processed, receipts are printed, doors close. But according to industry insiders, there are rare moments when a transaction doesn't move forward not because of attitude, not because of damage, but because a pattern suddenly stops making sense. That is where this story begins. In late season, at a flagship boutique handling high-value couture, an internal compliance review reportedly flagged a return that looked perfect, pristine seams, flawless fabric, correct tags, yet failed a deeper consistency check. No accusation, no confrontation, just a pause. And in the world of luxury, a pause is never accidental. What followed was not a scandal, not a headline, not even a complaint. It was a quiet escalation from retail staff to authentication teams, from accounting logs to archival records. Names were not spoken aloud. Files were opened instead. And somewhere between fabric analysis and financial reconciliation, a single question emerged. When does privilege stop being invisible to the system? This is not a story about fashion gossip. It is about how legacy institutions protect themselves when exceptions pile up, how compliance mechanisms awaken long after cameras leave, and how behavior that looks ordinary on the surface can appear very different under institutional memory. At the center of the narrative are elite clients, global brands like Chanel, and a public figure whose post-royal life has been built on visibility, Meghan Markle. But this story is larger than any one name. Stay with me because what happened next didn't unfold in public. It unfolded in labs, ledgers, and internal rulebooks that were never meant to be read aloud. To understand why a single return could trigger concern, you first have to understand how luxury fashion actually operates behind the scenes, because it is nothing like ordinary retail. At the highest tier of fashion, returns are not just financial transactions, they are data events. Every couture piece carries a quiet history. When it left the boutique, how long it was out of circulation, how often similar items have been returned, and under what circumstances. None of this is dramatic. It is procedural, and that is precisely why it matters. Former compliance officers from luxury houses describe returns as probability checks. A pristine item returned within policy is normal. Several pristine items returned over time may still be normal, but when timing, value, and usage indicators begin to align too neatly, systems designed to protect heritage brands take notice not emotionally, but mathematically. Contrary to popular belief, most high-end fashion houses do not rely on frontline sales staff to judge whether something was worn. Sales associates are trained to provide discretion, not investigation. The real evaluation happens later, often days or weeks after the item is back in inventory. That evaluation is handled by internal authentication and quality teams whose sole responsibility is to preserve brand integrity. What are they looking for? Not stains, not wrinkles. Those are amateur indicators. Instead, they examine stress patterns, how fibers compress under heat, how collars respond to prolonged skin contact, how linings absorb oils from cosmetics or hair products. These indicators do not accuse, they contextualize. They answer one question only. Was this garment used in a way consistent with a brief fitting or with extended wear? This is where luxury differs sharply from everyday commerce. In mass retail, a return is a reversal. In couture, a return is a re-entry into a closed ecosystem. And ecosystems, remember, there is also a financial layer that many consumers never see. High-value returns are reconciled against purchasing behavior over time. Brands quietly track frequency, item type, and refund patterns not to penalize clients, but to identify risk. This is standard practice across industries that deal in scarcity, from fine art to rare automobiles. Sources familiar with these systems emphasize an important point. Escalation does not happen quickly. It is slow, methodical, and intentionally silent. Luxury institutions avoid confrontation at all costs. They would rather adjust access than create public conflict. When questions arise, they are first asked internally, so when a return prompts a pause, it is rarely about that single item. It is about context, how this return fits into a larger behavioral record. And once a pattern is flagged, the process changes. Returns are no longer just returns. They become reference points. And reference points, once established, can quietly reshape how a client is viewed across an entire industry. In the next section, we'll examine how patterns, not people, move cases forward, and why repetition, more than any single act, is what transforms routine privilege into institutional concern. In large institutions, concern rarely begins with a person. It begins with repetition. Luxury houses, like banks and insurers, are designed to tolerate anomalies. One unusual return means nothing. Two still mean very little. But when certain variables recur, timing, item category, value, and post-use condition, systems quietly adjust their lens. What was once noise becomes signal. Industry analysts describe this stage as pattern consolidation. It does not involve accusations, and it certainly does not involve confrontation. Instead, historical data is layered over current activity. Purchases are compared across fashion seasons. Returns are measured not by policy compliance alone, but by behavioral consistency. At this level, brands are no longer asking, "Was the return allowed?" They are asking, "Does this behavior match how couture is normally used?" High-end garments occupy a strange space in commerce. They are sold like products, but treated like assets. Many pieces are produced in limited quantities, tracked individually, and expected to age in specific ways. When multiple garments re-enter inventory without the expected signs of life, no meaningful wear patterns, no natural creasing, no organic variance, the absence itself becomes notable. Former quality managers explain that this is where context matters most. A returned evening gown after a single appearance behaves differently from a jacket worn under studio lighting, movement, and extended contact. The difference is not visible to the eye, but it is measurable across time. And when several items from the same client produce similar measurable results, systems take notice. What makes this phase particularly sensitive is that no single return is ever isolated. Each transaction quietly references the last: duration out of inventory, event proximity, seasonal clustering. These data points are not dramatic, but together they form a behavioral silhouette not of intent, but of usage. It is also at this stage that internal roles begin to shift. Retail staff exit the picture entirely. The matter is no longer operational. It becomes analytical. Files move from point-of-sale systems to audit dashboards. Access is limited. Language becomes neutral, almost clinical. Crucially, the process does not ask why something is happening. It asks how often. Intent is irrelevant. Only consistency matters. Sources familiar with luxury compliance note that once a behavioral profile begins to form, brands typically take one of three paths. The first is silent accommodation, adjusting internal handling without altering the client experience. The second is controlled restriction, narrowing access to certain categories or services. The third is escalation, rare, deliberate, and typically reserved for situations where financial exposure or reputational risk intersects. Most cases never reach that third path, but there is a trigger point, and that trigger is almost always scale. As the number of reference points grows, so does the confidence of the pattern. At a certain threshold, the question shifts again. It is no longer, "Is this unusual?" It becomes, "Is this sustainable for the institution?" This is where systems designed to protect legacy begin to prioritize continuity over convenience. Brands that have existed for generations think in decades, not quarters. They measure risk not only in dollars, but in precedent. If an exception becomes repeatable, it becomes teachable, and what can be taught can be exploited. So when repetition crosses from coincidence into profile, institutions respond the only way they know how: quietly, internally, and with long memory. In the next section, we move away from patterns and into verification, the point where behavioral questions meet physical evidence and where assumptions are replaced by measurable facts. When patterns reach a certain threshold, institutions stop theorizing and start verifying. This is the moment where intuition gives way to measurement and where luxury quietly reveals how seriously it treats its own survival. Most people imagine fashion houses as creative studios filled with sketches and fabrics. Few realize that behind the showrooms and ateliers, there are controlled environments that resemble research facilities more than boutiques. These are not spaces designed to judge people. They are designed to evaluate materials impartially, repeatedly, and without narrative. At major heritage brands like Chanel, verification labs exist for one purpose: to determine how an item has been handled after it left authorized circulation. The process is not theatrical. There are no dramatic declarations. Garments are logged, cataloged, and examined under standardized conditions that have been refined over decades. What do these labs actually look for? Not damage in the way most consumers understand it. Scratches, stains, and tears are crude signals. Instead, analysts focus on micro-interactions, the subtle ways fabric responds to prolonged human presence. Fibers compress differently under sustained warmth. Linings absorb oils in patterns unique to movement. Cosmetic particles behave differently when transferred through brief contact versus extended wear. None of this is subjective. It is measurable. Technicians begin with comparative baselines. Every couture piece has a reference profile established at creation: fiber tension, weave elasticity, dye saturation. Returned items are compared against these benchmarks. Deviations are recorded, not interpreted. The goal is not to prove wrongdoing. It is to establish usage consistency. One former quality assurance specialist described the process simply: the garment tells its own story. We just document it. Dollar-to dues. This is also where many misconceptions fall apart. Luxury labs do not attempt to identify individuals. They do not speculate about motives. They answer narrow questions. How long was this worn? Under what conditions? Does the material behavior align with declared use? It is in answering those questions that internal clarity often emerges. Importantly, verification is rarely triggered by a single item. It is comparative. Multiple garments, reviewed independently, can produce similar data signatures. When that happens, analysts gain confidence, not about intent, but about pattern reliability. The data either converges or it doesn't. Once findings are logged, the results are circulated discreetly to internal stakeholders, compliance teams, inventory risk managers, sometimes legal advisors. The language remains restrained. Phrases like inconsistent with limited fitting or indicative of extended wear conditions are preferred. There is no emotion in the report. Emotion complicates decisions. And this is where the story becomes less about fabric and more about systems. Verification labs sit at the intersection of craftsmanship and accountability. Their work informs decisions that ripple outward, not only about individual items, but about policies, access, and exposure. When repeated findings align across time, institutions are forced to ask whether existing assumptions still hold. At this stage, many brands pause again, not to accuse, but to consider consequence. Escalation is never automatic. It is weighed against reputation, precedent, and proportionality. Luxury houses understand something fundamental. Public conflict damages everyone involved. That is why most decisions made at this level remain invisible. Adjustments occur quietly. Access narrows. Procedures tighten. Explanations are rarely offered because explanations invite debate and debate invites risk. For viewers watching from outside this world, it can feel opaque, even unsettling. That opacity is intentional. These systems were designed to function without spectacle. As we move forward, the focus will shift from physical verification to financial reconciliation, where material findings intersect with accounting realities and where questions of usage begin to overlap with questions of record. Before we continue, I'd like to briefly invite your perspective. These practices vary subtly across regions and cultures. If you're comfortable sharing, please let us know simply and respectfully the city or country from which you're watching today. It helps ground this discussion in the global reality these institutions operate within. In the next section, we'll explore how verification data transitions into financial review and why accounting, not fabric, often determines how far a case ultimately goes. If verification labs answer how an item was used, accounting departments answer a different, more consequential question. How was it recorded? This is where material findings intersect with numbers, and where quiet internal reviews can expand beyond fashion entirely. In the luxury world, accounting is not an afterthought. It is a parallel safeguard. Every high-value transaction creates a paper trail that exists independently of fabric, fittings, or appearances. Purchases, reimbursements, write-offs, and refunds are logged, reconciled, and reviewed over time. Individually, these entries are unremarkable. Collectively, they tell a story institutions cannot ignore. To understand why this matters, it helps to look at how wardrobe expenses are commonly handled in the entertainment and public-facing world. In many cases, clothing purchased for professional appearances, premieres, promotional events, media engagements may be routed through business entities rather than personal accounts. This is not unusual. Production companies, brand partnerships, and controlled LLCs routinely handle such expenses under established accounting frameworks. The key word is reconciliation. When an item is purchased through a business channel, it is typically categorized, logged, and accounted for according to its intended use. If the item is later returned and refunded, that refund must align with the original classification. The ledger expects symmetry. When symmetry breaks down, questions begin, not emotional questions, but mechanical ones. Sources familiar with compliance processes emphasize that accounting reviews do not assume wrongdoing. They flag discrepancies. A refund that does not clearly map back to an expense entry is not an accusation. It is an inconsistency. But repeated inconsistencies, especially involving high-value items, draw attention for a simple reason. Institutions are obligated to understand where money goes. This is where scale becomes decisive. A single reconciliation issue can be corrected quietly. Multiple issues across time force escalation not to protect reputation, but to protect compliance. At a certain point, internal accounting teams are required to involve external standards, especially when transactions touch regulated boundaries. In the United States, that boundary is often defined by Internal Revenue Service regulations. This does not mean an investigation is underway. It means accounting professionals must ensure that records would withstand scrutiny if reviewed. Their responsibility is preventative, not punitive. Industry accountants describe this phase as the most uncomfortable, precisely because it lacks drama. There are no confrontations, no public statements. There are spreadsheets, timelines, and reconciliations that must make sense on their own. When they don't, the system responds automatically. Another layer complicates matters further. Refund destinations. Refunds processed back to original payment methods behave differently than those redirected elsewhere. Each pathway carries its own documentation requirements. Over time, patterns in refund routing can become as informative as the refunds themselves. Again, this is not about intent. It is about traceability. At this stage, institutions are no longer thinking in terms of garments or appearances. They are thinking in terms of exposure, financial exposure, regulatory exposure, reputational exposure, and exposure, once identified, must be contained. This is why accounting reviews often move more cautiously than verification labs. Numbers are unforgiving. They either align or they don't. And unlike fabric analysis, accounting discrepancies cannot be explained by lighting, environment, or interpretation. They require resolution. Importantly, this does not mean conclusions are drawn quickly. Quite the opposite. Reviews at this level can take months, even years, as institutions cross-reference historical data and ensure proportional response. Luxury houses, especially those with global footprints, are acutely aware that overreaction creates as much risk as inaction. What begins as an internal review may remain internal indefinitely. But once financial questions overlap with usage, verification, and behavioral patterns, institutions reach a point where silence is no longer a strategy. It becomes a liability. In the next section, we'll examine how financial exposure rarely stays contained to one individual or one account, and why secondary names and associations can surface even when they were never central to the original activity. By the time a review reaches this stage, the focus has shifted again. It is no longer centered on garments, transactions, or even individual decisions. It is centered on exposure, the kind that spreads quietly through associations, shared records, and overlapping responsibilities. Large institutions understand something that individuals often underestimate. Financial systems do not operate in isolation. Accounts connect. Authorizations overlap. Names appear on documents for reasons that have nothing to do with daily involvement. And when reviews expand, those names surface not as accusations, but as points of reference. This is where many public narratives become distorted. The appearance of a secondary name in a financial review does not imply direction, intent, or control. It implies linkage. And linkage, in regulated environments, requires clarification. In high-net-worth households and public-facing partnerships, it is common for financial instruments to be shared. Credit cards may carry multiple authorized users. Corporate entities may be jointly controlled. Refunds, reimbursements, and expenses can legally flow through accounts that serve logistical convenience rather than operational authority. None of this is unusual, but when systems review transactions historically, they do not interpret context, they document structure. This is why secondary names can appear in internal reports even when those individuals have publicly stated that they were not involved in specific decisions. The system does not evaluate statements. It evaluates records. For institutions managing risk, this creates a delicate challenge. On one hand, they must ensure compliance and clarity. On the other, they must avoid overreach that could unfairly implicate parties whose involvement was peripheral or procedural. This balance is one reason reviews at this level proceed slowly and discreetly. Sources familiar with compliance stress an important distinction. Being referenced is not the same as being responsible, but reference still carries consequence. Once a name appears in documentation tied to potential exposure, institutions must confirm that the relationship is understood and accurately represented. This is particularly sensitive when public figures are involved. Names associated with recognizable institutions, royal households, charitable foundations, production companies carry symbolic weight beyond their legal meaning. Even when involvement is minimal, visibility amplifies perception. And perception, in legacy institutions, is treated as a risk factor in its own right. At this stage, decision-makers begin to consider not only what happened, but how any action might be interpreted if it were ever disclosed. This is where reputational calculus enters the equation. Not because institutions fear scrutiny, but because they understand its cost. It is also here that silence often becomes more pronounced. Contrary to popular belief, the absence of public statements during internal reviews is not evidence of concealment. It is evidence of containment. Institutions avoid commentary precisely because commentary creates narrative momentum, and momentum removes control. For individuals linked by association, this period can be uniquely uncomfortable. There may be no formal accusation, no notification, and no clear resolution timeline. Records are examined, questions are asked internally, and life continues outwardly unchanged. This ambiguity is not accidental. It is procedural. In some cases, associations are clarified and documented without incident. In specs are closed, exposure is downgraded, no further action is required. In others, the presence of multiple linkages, financial, operational, reputational prompts broader review, not because of wrongdoing, but because of cumulative risk. What matters most to institutions at this stage is precedent. How they respond now shapes how similar situations will be handled in the future. Overreaction can damage relationships. Underreaction can damage credibility. The correct response lies somewhere in between, quiet, deliberate, and difficult to observe from the outside. As this process unfolds, another reality becomes clear. Once exposure extends beyond a single profile, the issue is no longer personal. It becomes systemic. And systemic issues rarely end with explanations alone. They end with change. In the final section, we'll examine what that change looks like, how industries respond not through public reckoning, but through rewritten rules, tightened access, and silent shifts that permanently alter who is welcomed and under what conditions. When stories like this surface, it's tempting to search for villains or heroes. But the deeper lesson isn't about any single name. It's about how systems respond when privilege becomes routine, and when routine quietly turns into risk. Legacy institutions don't react with outrage, they react with memory. They remember patterns long after headlines fade. They don't argue in public, they adjust in private. And when they change, they rarely announce it. Access narrows. Exceptions disappear. Doors that once opened effortlessly begin to close not with confrontation, but with silence. There is something profoundly instructive in that restraint. In everyday life, many of us believe that success is measured by visibility, by how often we are seen, invited, or celebrated. But legacy operates on a different scale. It values consistency over charisma, stewardship over spectacle. It rewards those who understand that trust, once questioned, is never fully restored by explanation alone. From a personal perspective, what stands out most in this story is not the mechanics of fashion or finance, but the human tendency to assume that systems will always look the other way. They rarely do. They simply take longer than we expect. And when they respond, they do so in ways that are permanent, not performative. That is the quiet power of institutions that have survived generations. They don't need to win arguments. They just need to endure. Here at Edge of Legacy, our goal isn't to pass judgment. It's to explore how influence, access, and accountability intersect in the real world, often far from public view. If this story prompted reflection, curiosity, or even disagreement, that conversation is part of the value. If you found this analysis thoughtful, please consider liking the video. It helps this channel reach others who appreciate deeper narratives. I'd also welcome your perspective in the comments. And if you'd like more stories that examine legacy beyond the headlines, I invite you to subscribe to Edge of Legacy.